Hey everybody, in this video, I'm gonna show you exactly what I own in my $76,000 M1 Finance portfolio. And I've talked about a goal of building that portfolio from $10,000 in the beginning of February of this year to $1 million over 10 years. So I'm gonna show you exactly what I need to do to make that happen. All right, here we go. So let's talk about exactly how much this $76,124 portfolio made this week. This week, it's a growth-oriented portfolio, so not dividend payers. This week, the portfolio made $1,881, and it was up 2.6%. That's pretty awesome to see $1,800, almost $1,900 in growth in the portfolio over a week. But full disclosure, the portfolio is down since we started it in February. It's down $6,354. But hey, an $1,800 week is pretty great. In the portfolio, I own Snowflake, Crowdstrike, Meta, Datadog, Gitlab, RKLB, Tesla, MongoDB, the Trade Desk, and Cloudflare. So I've got this goal of building this portfolio from this $76,000 now to $1 million by 2032. And what I want to share is exactly what those numbers look like. What is it going to take for this portfolio to get there? And I'm talking about two funds that I think are great options because investing in individual stocks can be super risky and super dangerous. So none of this is financial advice. People have to do their own research, but I'm going to share two funds that I like at the end of this video. This is a compound interest calculator. And the thing that people don't want to talk about when they talk about building big portfolios is that the best way you can do it is to add money to the portfolio. So I've got a lofty goal of adding $3,000 per month to this portfolio. And I understand a lot of people aren't able to do that, and that's fine. I oftentimes throughout my life have not been able to do anything near that, but I started with what I could and I grew it over time. So I just want to share this example. Right now we're starting at $76,100. We've got 10 years from now, so that brings us to 2032. This is a rate of return of 14%, which on average, the market only does 8 to 10%. So we have to remember that. But if I'm doing $3,000 a month, I've got to return 14% a year for the next 10 years to get to that $1 million mark. And the truth is that this isn't about 10 years from now for me. This is about 20 years and 30 years from now. So in order to hit 14% per year, I've got to take a lot of risk, right? Well, what if I want to change that equation? Let's bring it down to what the market averages each year. Market averages about 8% per year. So if I lower that down and I'm doing $3,000 a month and I make 8% a year, then I'm going to make $708,000 after 10 years. Well, guess what? That still would be fantastic to have that much money after 10 years. So that's the first thing. Even if I miss this $1 million goal, big deal. At least I'm saving and at least I'm investing. But guess what? The number one way that we can extend this and beat our goals is to start investing earlier or invest longer. So what if we just do 13 years? If we go out 13 years and we're making 8% a year versus 14%, we still hit that $1 million mark. And so that's the key I hope you leave this video with. Invest what you can when you can. Increase that amount as you can over your career. A tip is every time my wife or I got a raise, we would take 50% of that income increase and add that to our investments. And then we would use the other 50% to live our lives and enjoy it. So that way we have this mix of enjoying it when we make more money and get promotions or get raises, but also adding more and investing more. And so that's the big takeaway is if you want to build $1 million account, start as early as you can, make your timeline longer, and then add more money as you can over time. So let's talk about two funds. And we talked about that 14% mark, which is high, right? But here's SCHD. I've talked about this before on the channel. It's a pretty safe dividend fund. It has historically been pretty safe and not very volatile. It is a dividend growth fund from Schwab. Check the channel. I did a video on it. But if we look at its 10-year history, hey, look at that. Total return percent, 13.37%. This is a dividend fund. And it's right up there at that 14% mark. So it is possible. It's been a great 10 years, but the market has also sold off quite a bit now. And we have a chance to do better than what the market has done on average over the next 10 years. Is that destined to happen? No. It could be a lot worse. Who knows? Here's another fund. This is a growth-oriented fund, VUG. I've done a video on this as well. So check that out. It has more growth and more textile stocks that you're familiar with. And look at that, 10 years, 14.85%. So hitting almost 15% on average per year. Over 15 years, it's down to 11%. So I think that brings in close to 2008, 2009. I'm not very good at math, but I think that's why that's a little bit lower. So two options there. And if you want to look at the stocks in the portfolio, just to give you a quick idea, here you go. These are the types of stocks you get exposure to in VUG. Apple, Microsoft, Amazon, Alphabet, Tesla, Alphabet Class C, Meta, NVIDIA, Visa, the Home Depot. Those are the top positions. So I talk about a lot of individual stocks. They're not for everybody. You can get exposure to the same types of stocks I'm talking about, actually probably a little less risky than the ones I own, in VUG. And then in SCHD, if you look at that, the top positions are Texas Instruments, Pepsi, Coke, Amgen, Cisco, the Home Depot, Merck, Pfizer, Broadcom, and IBM. And you can see the big thing that this offers that the other one doesn't is a lower price to earnings ratio than VUG and a 3.72% dividend yield, which is pretty darn attractive from these safe companies. So if you like this content, if you want to stick along for this journey and see if I make this goal or drastically miss it, just do me a favor, like the video, subscribe to the channel so you don't miss an update, and then let me know in the comments if there's any stocks you want me to review.